Ever wondered what PE and DE ratios are and why these two ratios are important in analyzing a stock? Well, this is the first video on series Finance Jargons Made Simple. So, price to earnings ratio is a measure that whether the stock price is cheap or expensive in relation to the company's profit. Simply, it is price tag of the company's profitability. The formula is simple: stock price divided by the earnings per share. So, PE tells you that how many rupees are you ready to pay for each 1 rupees of the company's current profit. So let's say a company in an IT industry is having a PE of 35. That means an investor is ready to pay 35 rupees for each rupees of the company's annual profit, because it is expecting the company to grow in the near future. On the other hand, if the stock is having a lower PE of let's say 12, like an old public sector bank, it looks like the stock is cheaper, but the market expects a lower growth in the near future. So it is always better to compare stock's PE with the Nifty 50 average and PE of its direct competitor in the same sector. What is debt to equity ratio? Consider it to be as a financial riskometer. It tells you how risky the company is. Debt to equity ratio compares how much money the company owes versus the money that the company owns to its shareholders. If the debt to equity ratio is 2.5, it means company owes 2.5 rupees of debt in respect of every 1 rupee that it owns to its equity shareholders. Capital intensive industries, higher debt to equity ratio is common because these companies require larger loans to fund their capital investments. However, if the business struggles, a higher debt to equity ratio can take the company into massive stress because of payment of interest. A lower debt to equity is used in service-based industries. These companies are more stable or conservative. On the other hand, a higher debt to equity is used as a higher leverage and greater risk. So, PE is used to find the value and DE is used to measure the risk.